We shall commence this module by studying about the foreign capital as a source of finance. In the post-globalization era, it is really difficult for a corporation to grow and foster in a highly competitive, volatile market scenario when the domestic capital in supply is limited. In most of the emerging economy, capital is a major constraint for growth of an organization. But capital is no more an obstacle for business to grow after the integration of domestic market with world market with rapid liberalization in the direction of transfer of capital, manpower, technology, expertise, intellectual properties rights, know-how techniques, etc. among the economies. If an economy has growth potential and business environment is favorable, it could attract huge amount of foreign capital. The foreign investors, like any other investor, expect better returns from their investment, and if the host economy has the potential to provide better returns, capital would flow in. In addition to the investment return, the host economy needs to have sound law and regulations to ensure the confidence of foreign investors in the domestic economy. After studying this module, we shall be able to know the sources of raising funds in the primary capital market, that is through international capital market. Then we will study the meaning and features of global depository receipts. Then we will discuss the meaning and features of American depository receipts. And then we will discuss the factors leading to an increase in the popularity of international market for raising the finance. And then finally we will discuss and understand the meaning of ECBs and FCCBs. Now we start with defining and understanding the meaning of foreign capital. As the name suggests, the term foreign capital is a non-domestic source of financing for an organization or government. Foreign capital is an important factor for growth of an undertaking in an emerging economy where domestic capital in supply is normally limited. Countries like India, China, Brazil and some other emerging economies frame liberal policies to attract foreign investors to invest in their economy with the expectation of growth, employment and development in the host economy. Let us have a look at what are the major sources foreign capital can be raised and how they are different from each other. We have certain important foreign sources of finance, namely first, foreign direct investment, foreign portfolio investors or foreign institutional investors, external commercial borrowings or euro issues, namely American depository receipts, ADRs, global depository receipts, GDRs, foreign currency convertible bonds, FCCBs, foreign currency exchangeable bonds, FCEBs, foreign venture capital investor, borrowings from international monetary funds, foreign aid, that is loan or grant. So first we start with foreign direct investment, that is FDI. FDI is the investment made by an entity of an economy other than its national economy into an entity of a foreign national where it wants to have substantial influence and control over the entity. For example, POSCO Steel conglomerate of South Korea wanted to invest in the state of Odisha, that is India, by opening a subsidiary in the name of POSCO India. POSCO would be major shareholder of the company and it would have substantial influence over the management, control and decision making in the subsidiary. In this scenario, India would be the host country which would receive the FDI, that is inflow of FDI into India. When Tata Group acquired Jaguar and Land Rover from Ford in UK, the money was transferred from the domestic economy, that is India, to foreign country UK. It shows the outward of FDI. FDI is a major component global integration these days. Trans-border transfer of capital is no more an uncommon phenomena to the globalized open economies. Increase in the number of many large MNCs and conglomerates are the result of FDIs. Through expansion, growth and diversification of corporates in the foreign lands other than the place of origin. Unlike the indirect portfolio investment, which mostly invest in the securities listed in the stock exchange in the secondary market, FDI is a direct investment in the company where the investing entity would have significant degree of influence. There are two broad ways of FDI investment, that is, one is greenfield investment, where the investing entity set up a new subsidiary company in the foreign land, for example, POSCO's investment in India. And the other one is brownfield investment, where the investing entity either acquire or enter into joint venture or merge with the foreign company or entity. For example, Tata Group acquires Jaguar Land Rover from Ford Motors. This is exit of FDI. Normally, an open economy with strong growth potential, material resources, skilled cheap labor force and better regulation in place attract more FDIs. FDI fill the gaps between the savings and investment in the economy. For example, an economy has much more growth potential than its current operating level, but the investment needed to capitalize this growth could not be met from the deficit domestic capital market in supply, that is saving. This gap could be filled by FDI. Hence, FDI is major source of foreign capital for emerging economy where mostly saving is less to the investment needs. Now we move on to the foreign portfolio investment, that is FPI. FPI are the foreign institutional or individual investors who invest in the security market other than the domestic security market in different class of assets like bonds, debentures, equity, etc. For example, pension funds, insurance funds, mutual funds, banks are the institutional investors registered in the USA make investment in the Indian domestic security market, then they would be treated as the foreign institutional investors investing in portfolio of Indian securities. The FIIs are just like domestic institutional investors. The only difference is they are registered in the foreign land and funds at their disposal are from the resident of foreign land. In Indian security market, foreign individual investors are not allowed to invest directly until now. If they want to invest, they could come through the FFIs or sub-account under FFIs. Unlike FDI, FPI investors are not interested in the management and control in the company. They want return from the security market like any other investor. The FPI investment are relatively liquid and more volatile than the FDI investment. The FPI investors say invested till the time they get returns, they withdraw money from the market if loss arises because they don't have long-term interest in the company like FDIs. We observed a severe withdrawal by FPIs in 2008-9 during US financial crisis from Indian security market. Through FPI is a major source of finance, but it is not a reliable source like FDIs. We could see from the yearly investment made by the FPIs in the Indian economy in secondary market. For India, FPI is a large source of foreign capital. Now we move on to the third source of foreign capital, that is external commercial borrowings. External commercial borrowings are the commercial loans in the form of bank loans, fixed rate or floating rate bonds, non-convertible or partially convertible or optionally convertible preference shares borrowed from the foreign resident with minimum average maturity of borrowings is 3 years. The external commercial borrowings is one of the major sources of raising foreign debt capital by Indian corporates from foreign lenders. Reserve Bank of India, in consultation with Department of Economic Affairs, Ministry of Finance, regulates the ECBs. ECBs could be raised in two ways, that is automatic route or approval route. The raising ECBs under the automatic route does not require government or RBI approval. The following are the eligible borrowers of ECBs under the automatic route. First, the corporates, including those in the hotel, hospital, software sectors registered under the Companies Act, non-banking finance companies, infrastructure finance companies, NBFCs, asset finance companies, small industries development bank of India, special economic zones or IFCs are permitted to avail of ECBs for on lending to the infrastructure sector as defined under the ECB policies. Then we have NBFCs or AFCs. They are permitted to avail ECBs for financing the import of infrastructure equipment for leasing to infrastructure projects. We have non-government organizations also engaged in microfinance activities. They are eligible to avail of ECBs. And then we have microfinance institutions. The borrower of the ECBs has to utilize the proceeds in compliance with the regulations of ECBs, which permit the proceeds to be utilized for the same purpose for which they have taken. And this is decided. For this, they do not have to take the permission of the RBI in order to capital expenditure, modernization, expansion, import of capital goods, etc. Working capital or repayment of rupee loans with conditions prescribed in regulation to repay trade credit taken for a period of maximum up to 3 years for capital expenditure. For payment towards capital goods already shipped or imported but not paid, purchase of second-hand domestic capital goods, plant, machinery, etc. All this can be done through automatic permission of the ECBs. Now we move on to the discussion of Euro issue. Euro issue are the financial instruments to raise funds from the non-resident investors other than the domestic currency. In simple Euro issue, they are sold in the foreign currency by the corporates to the foreign investors, and the principal and the interest are supposed to be paid in the specified currency in which the instrument is issued. For example, an Indian company may issue bonds or some other securities in US dollars, euro, yen, British pound or any other foreign currency other than rupee. The following are the popular Euro issue, that is American Depository Receipts. The very first is American Depository Receipts. They are just like any other stock traded on the stock exchange of USA. But these stocks are not the stocks or shares of the companies registered in USA. These are the stocks or shares of companies registered in foreign land purchased by the banks or depository institutions of USA and converted into US dollar denomination, ADRs, and sale to the resident investor of USA. ADR was introduced because of number of problems associated with the process of purchasing stocks in the corporates registered in the foreign country. How does Indian company raise capital through ADRs? It's very simple. The Indian corporates issue shares to the registered institutional depositories of USA, and they further issue these shares to the domestic investors of USA in the form of ADRs. The principal and dividend are paid in US dollar. The ADR is a nice way to invest in the foreign corporates for US investor, and for Indian corporates nice way to raise funds from non-resident investors. Likewise, ADRs, Indian investors invest in foreign securities through Indian depository receipts. Then we have second method is global depository receipts. Global depository receipt is a financial instrument in the form of depository created by the overseas depository banks, financial institutions issued in more than one country. GDR is just like ADR but traded in non-US market like Japan, London, Singapore, Hong Kong or any other stock exchanges. The third type of Euro issue is foreign currency convertible bond. FCCBs are bonds issued by Indian companies expressed in foreign currency to the non-resident investors. The principal and interest in respect of instruments are paid in the specified foreign currency. The FCCBs have to be issued in accordance with the issue of foreign currency convertible bonds and ordinary shares scheme 1993. The bond is convertible into shares of issuing company in any manner like wholly or partly or on the basis of any equity related warrant attached with the debt security. The investor of the FCCB are mainly interested in the capital gain from the conversion of bonds into equity shares of the issuing company. Hence, it is not surprising that FCCB provide lower coupon to the investor. In addition to this, the issue of FCCB must comply with FEMA, that is Foreign Exchange Management Act. FCCB has been a source of raising foreign capital since 1993. The convertible part of FCCB makes it a quasi-debt instrument as the FCCB's holder possess the right to convert the bond into the equity shares of the company. It gives taste of both bonds and shares. FCCB give an opportunity to raise capital from foreign lenders in a foreign currency. FCCB gives advantage to both issuer and lender. Issuer get access to foreign capital at lower rate of interest, and the lenders get fixed periodical coupon payments and capital gain from the appreciation in the share prices. The holder of the bonds possesses the option to convert the bonds into equity. Rationally, the FCCB's holder would exercise the conversion right when they make decent capital gain, otherwise ask for redemption. Conversion of bonds to equity has to be completed in the stipulated time frame in accordance with the term and conditions of the issue. If the bondholders choose to convert the FCCBs, then the holder would receive shares of the issuing company at predetermined rate or at the rate determined when FCCBs was subscribed. The conversion price normally adds some premium over the market price prevailing at the time of issue. The next type of euro issue is foreign currency exchangeable bonds, that is FCEBs. FCEBs are the bond issued to the non-resident lender in foreign currency like FCCBs, but there is difference that it is in regard to convertibility, that it would be exchangeable into equity share of other company called offered company, wholly or partly or on the basis of any equity related warrant attached to the debt instrument. Here we have eligible issuer is the issuing company, that is a part of promoter group of the offered company and shall hold the equity shares being offered at the time of issuance of FCEBs. Here the offered company is the listed company which is engaged in a sector eligible to receive foreign direct investment and eligible to issue or avail of foreign currency convertible bond or external commercial borrowings. There is a little difference between FCCBs and FCEBs. In FCCBs, the bonds would be converted into shares or stock of issuing company. On the other hand, FCEBs are issued by holding company of group, hence provide the option of exchangeability of shares in the group's subsidiary as mentioned in the issue document. Hence, FCCBs involve only one company, but SEBs involve at least two companies. Now we move on to foreign venture capital investor. Foreign venture capital investor is an investor registered and established outside India, which is registered under the Securities and Exchange Board of India, namely Foreign Venture Capital Investor Regulations Act 2000, and proposes to make investment in accordance with these regulations, which normally invest in startup companies with growth potential but also involve high risk. Now we are going to understand the meaning of borrowings from international financial institutions. Capital borrowed from multilateral financial institutions like IBRD, IDA, ADBs, BRICS, banks, IIDBs, IFCs, etc. for major infrastructural development projects by the government and private undertakings involve greater confidence to get the finance. These kind of capital are borrowed for a longer period of time, normally 5 to 20 years period, because the project is to be financed from these capital requires long-term gestation period. The projects like mega dams, water projects, electric power generation, metro rail project, nuclear plant, etc. require long time borrowings, and these borrowings are funded through these institutional agencies and they are specifically meant for these purposes. IFC is known as International Financial Institution. IDBI is known as Industrial Development Bank of India. They are major multilateral financial lenders to the private sector undertaking. Now we move on to understand the meaning of foreign aid. Foreign aid is concessional grant or loan normally given by developed countries to the developing or underdeveloped economies or of strategic importance. Foreign aid is not liked by any other source of foreign capital. The developed countries give huge amount of foreign capital to these developing or underdeveloped countries. Through this method, they want to control the political or economic exertion over these countries. Huge political and economic equations are offered through this foreign aid. They either want access to market by demanding liberalization, that is opening up of market for international trade, access to the cheap labor market, raw material, consumer base, any defense deal or business deal etc. from the receiver of foreign grant. Grant element of foreign aid is exempted from repayment, but the loan amount has to be paid back to the countries they are giving foreign aid. These aids are given for specific purposes like infrastructure, education, poverty alleviation, construction of roads, dams, military, fighting terrorism, etc. In addition to the developed countries, multilateral institutions like IBRD, ADB, IDA, etc. also provide foreign aid to the underdeveloped or developing countries with variable grant element. Now finally, we are going to make a summary of what we have discussed so far. We have started our discussion with the introduction of foreign capital. Foreign capital is a crucial participating and important factor for growth of an undertaking in an emerging economy where domestic capital of supply is normally short of requirement. FDI is the investment made by an entity of an economy other than its national economy into an entity of a foreign nation where it wants to have substantial influence and control over the entity. We have FPIs. FPIs are the foreign institutional or individual investors who invest in the security market other than the domestic security market in different class of assets like bonds, debentures, equity, etc. Then we have discussed ECBs. ECB is one of the major sources of raising foreign debt capital by Indian corporates from foreign lenders. Reserve Bank of India, in consultation with Department of Economic Affairs, Ministry of Finance, regulates the ECBs. Then we have discussed Euro issues. Euro issues are the financial instruments to raise funds from the non-resident investors other than the domestic currency. Capital also borrowed from multilateral financial institutions like IBRD, IDA, ADBs, BRICS Bank, IDBI, IFCI, etc. for major infrastructure development projects by the government and private undertakings. Then we have discussed the foreign aid. Foreign aid plays an important role in the development of the underdeveloped or developing economy, but it is also a control over the developed and underdeveloping economy by the developed countries because through foreign aid they forces their conditions over these economies. But it has a positive point that it helps in getting finance for the growth of underdeveloped or developing economies.